Okay, welcome back. We are doing chapter 10. We are on page 4, section B. So we are continuing with an example in foreign currency translation. And just a reminder that we are recording transactions in Canadian functional currency through this whole chapter. Okay, so let's go through an example. April 1st, year 3, oil and gas company purchased merchandise from a supplier in Europe for 22,000 euros with payment to be full made in 60 days. Okay, so one thing I want to make clear with these questions, it can be a little unclear. If something says order, if we made an order, it's not recorded. Now you learned that way back in 311, probably in passing. But if there's an order, it's not recorded. When it actually says purchased, that means transaction has occurred. Can't spell occurred. Hopefully it's close to being right. So oil and gas purchase merchandise from a supplier. So does that mean we're going to have to give away foreign currency in the future, or we'll be getting a bunch of it? Well, if we made a purchase, we're going to have to pay the supplier euros. So we're giving away in 60 days. Okay? It's really important with these that you know whether you're giving away euros or you're getting euros or whatever currency we're in. So be careful with that. So we need the journal entries in Canadian dollars because that's our functional currency. To illustrate the company's purchase of merchandise, remember I said there were 3 dates. So that's the first one. The year-end adjustments, the second one, and the subsequent payment. And the year-end is April 30th. So what we've given you is dates, and we've given you the exchange. So that's the spot rate. Remember we said a spot was just the rate on a certain day. So let's go ahead and start putting our entries together and see how we do. So April 1st was the purchase. Not an order, it was a purchase. So what are we buying? We purchase merchandise, so we're going to debit inventory. And we're going to credit accounts payable because the payment's not going to be made for 60 days. So we can't put 22,000 down because that's in euros and our books are in Canadian dollars. So we're going to have to convert it. 22,000 times the conversion rate today on April 1st is $1.49. So that works out to 32780. 2780. So, first thing I want to look at. I want you to think which is monetary and which is non-monetary. Is inventory monetary or non-monetary? Well, there's no right to get cash, so this is non-monetary. No adjustment later. AP, on the other hand, is monetary. So it will need to be adjusted at year end. Okay? Never mind. Okay, remember, if you do have questions, just email me. So, after April 1st, our purchase, when's the next time we have an entry? Well, year end. Now, if year end wasn't till August, we'd go right to May 31st. But year end's in the middle. So, we're going to put year end of April 30th. And we're going to adjust AP to fair value. So in order to do that, we need to know if we have a loss or a gain, how the exchange rate has gone for accounts payable. So we're going from April 1st to April 30th. And the exchange rate, what we have to pay in Canadian, has up. Okay? But we can't say if it's good or bad until we determine whether we're giving euros away or if we're getting them. So, in this case, we purchased, so we have to give away or pay in euros. So, we have to give euros in the future. And what happened to the price of the euro? And if thinking of a euro and currency hurts your head, just imagine this is 1 pen. 1 pen used to be worth $1.49 Canadian. Now that 1 pen is worth $1.51. But we have to give a bucket of pens away. And these pens just got more expensive. So the euro or pen increased, which is bad for us because we have to buy a wheelbarrow full of it to give to the other company. So bad for us because we have to buy a bunch of them to company. So it just got more expensive to fill our wheelbarrow with euros or with pens, because now we're paying 2 cents more for every euro pen, whichever way you want to think of it. So that's bad for us. That means we've got a loss. So we're going to debit loss on exchange and credit AP. Notice it's AP we're adjusting because it's monetary. We're not adjusting inventory. So we're just going to take the difference between the exchange rates. So 151 minus 149 times 22,000. And that works out to 440. Now, just one note, Connect, if they don't give you a separate loss on exchange and a separate gain on exchange, just loss gain, you can just use the one account. So sometimes this is just one account. It's gain loss on exchange. So just watch for that. Okay. So that's the year end. There was a loss because our euros, to get a wheelbarrow and wheel them over, and obviously you guys, all this stuff now is done electronically. There's going to be no exchanging of actual currency. But sometimes it's easier to think of it going, okay, we have to pay them in euros, so we need to go buy some, put them in the wheelbarrow and wheel them over. Well, they've just gotten more expensive by 2 cents per euro, so we've lost 440 because AP has gone up. So AP has increased. Okay, so that's year end. Now the very next is going to be settlement. And settlement is on May 31st. You'll never have to count the days, you guys. Will always tell you what the date is. May 31st, settlement. Okay, I'm going to do it in 2 entries. You are welcome to do it in 1. I'll show you both, and then you should be good. So the first thing we're going to do is adjust AP to fair value because it's the monetary item. So here we have our little APT account. We originally had 32,780 in it. We had to increase it by 440. So we have to look up here and decide whether we had a gain or a loss or what happened. So up here from April 30th to May 31st, what happened to the euro? It dropped. So the euro went down. Since this all goes to the fact that we have to pay the supplier, euro went down. This is good for us as we are paying the supplier. And now it's cheaper. So remember that €1 used to cost us $1.51. Well, it's only $1.46. So we gained. We can reduce our AP. So we are going to debit AP to reduce and credit gain on exchange. And that's for $1.51 minus $1.46 times 22,000, which is 1,100. And so we've got 1,100 in there, and our balance is now 32. So that was the first step. Now all we have to do is settle it. So 2 is pay for the inventory. So our accounts payable balance is 32,120. We're going to close E for 32,120. And we're going to credit cash for 32,120, which is 6 times 22,000. And they should equal because you've done so. We got this from here, and this calculation went here. These should equal if you've done everything right. So if you did want to combine them, you've got room for debits and credits. Well, you know how much cash you're going to credit. You calculated it. You have to calculate the gain on exchange, just like you did up there, for 1,100. And that means you're going to debit AP 32780 plus 440, which is 33220. If you are going to combine them, and Connect may make you, people forget the gain most often. So just make sure you've got your gain in there and you'll be good. Okay, so this was an example of us importing. We bought something from a foreign company, had to pay them, it's an import. So I just want to show you the difference now in example 2 on page 5 of an export. So we made a sale in this one. Okay, so on November 1st, year 15th, year 1, Regina Malt Producers shipped a cartload of malt. So, has the transaction already occurred? Yes. already shipped. So transaction has occurred. A carload of malt to a brewery in the United States. Full payment will be received January 31st, year 2. So, we, Regina Malt, are selling inventory. So we will be getting US dollars in the future. So we'll be getting US dollars in the future, and then we will convert to Canadian. So again, they've given you the spot rate for the 3 dates: the date of the transaction, year end, and then settlement. Those 3 dates are going to happen over and over. So the first date, the transaction, we've got a receivable and we've got sales. Sales is non-monetary, and accounts receivable is monetary. So we're going to have to adjust accounts receivable at year end. So we took the $26,000 and just multiplied it by the spot rate on November 15th. Then it's the year end. We have to find out if we had a loss or a gain. So $1 US went from $1.34 Canadian down to $1.31. So the US dollar went down. It got cheaper. If it was a pen, the pen got cheaper. That dollar got. So is that good or bad for us? It's bad for us because we're getting US dollars.